The U.S. Department of Justice is reportedly reviewing actions connected to Federal Reserve Chair Jerome Powell, and the most important detail isn't what is being examined, but why this moment matters for the entire financial system. This is not about a sudden arrest, and it's not a verdict. According to publicly available reporting, it's about whether certain decisions, communications, or disclosures crossed a legal boundary, and how rare it is for a sitting Fed chair to even be mentioned in this context. At first glance, it may sound procedural, quiet, almost technical, but historically, moments like this tend to expose much deeper tensions between political power, financial independence, and public trust. And that's where the story actually begins. The strongest signal didn't come from a press conference. It came from confirmation that federal prosecutors are, reportedly, gathering information related to Jerome Powell's conduct as Fed chair, a step that, by design, happens behind closed doors and without public accusation. No charges, no conclusions, just scrutiny. And for an institution built almost entirely on credibility, scrutiny alone carries weight, because the Federal Reserve is structured to operate independently of political pressure. Its leadership is insulated precisely to prevent this kind of moment from influencing markets or policy. So when the Justice Department becomes even tangentially involved, observers don't ask what happened first. They ask, what does this mean for the balance of power? To understand why this matters, you have to start with how unusual it is. Fed chairs are among the most protected officials in Washington, not personally but institutionally. Investigations involving them are rare, sensitive, and typically avoided unless prosecutors believe there is a legitimate legal question that cannot be ignored. That doesn't imply guilt, but it does imply seriousness. According to sources familiar with the matter, the review centers on decisions and disclosures made during Powell's tenure. Decisions that affected markets, financial institutions, and public confidence at critical moments. And that immediately raises a difficult question. Where does policy judgment end and legal accountability begin? This is where the story becomes less about Jerome Powell as a person and more about the system around him. The Federal Reserve doesn't just set interest rates, it signals, it reassures, it stabilizes expectations. Every word from the chair is parsed by investors, governments, and global institutions. Even minor deviations in messaging can move trillions of dollars. So when federal investigators reportedly look at communication practices, timing of disclosures, or internal decision-making processes, they aren't asking whether a policy was good or bad. They're asking whether established rules were followed, and that distinction is critical. Publicly, the Fed has maintained its standard position that it operates within the law, follows ethics requirements, and remains committed to transparency. Privately, however, the existence of a DOJ review introduces uncertainty. And uncertainty is something markets dislike more than almost anything else. But here's the part that often gets missed. This probe, if it exists as described, is not necessarily about a single action. It's about precedent. If prosecutors establish that a Fed chair's decisions can be criminally reviewed in this way, it could subtly change how future chairs act, what risks they take, what decisions they delay, and how independent the institution truly remains. That's a long-term consequence, not a headline. There's also timing. The review reportedly comes at a moment when the Fed's actions have already been under intense public and political scrutiny, from inflation responses to interest rate hikes and emergency measures taken during periods of economic stress. Each of those decisions had winners and losers, and where there are losers, there are always complaints. Most complaints go nowhere, but occasionally one reaches a level where federal authorities feel obligated to look, not because of pressure, but because of process. And that's the uncomfortable gray zone this situation sits in. It's also important to be precise with language. A criminal probe does not mean criminal conduct has been established. A review does not mean charges are coming. And silence from the DOJ is standard, not suspicious. In fact, if history is any guide, most reviews involving high-level officials end without public action, precisely because the bar for moving forward is so high. Still, the very existence of the review changes the conversation, because for the first time in years, The question isn't just what will the Fed do next? It's who is watching the Fed and with what authority. And that leads to the next layer of this story, the part that connects law, politics, and financial power in ways most people never see. Because once prosecutors look at the Fed, even cautiously, it raises a deeper issue that goes far beyond Jerome Powell. Can a central bank remain truly independent if its leadership operates under the shadow of legal interpretation? That question has no easy answer. And in the next part, we'll break down what kind of actions typically trigger DOJ interest, how previous high-level financial reviews unfolded, and why this situation is being discussed so carefully, even by people who strongly defend the Fed. To understand what could realistically prompt interest from the Justice Department, it helps to look at the narrow categories where legal review and central banking occasionally intersect. Not policy disagreements, not unpopular rate decisions, and not market outcomes. Historically, DOJ scrutiny in financial leadership cases tends to focus on process, not results. Things like disclosure timing, conflicts of interest, internal controls, or whether required safeguards were followed during extraordinary interventions. That distinction matters because the Fed's mandate explicitly gives it wide discretion, but discretion still operates inside rules. And those rules are what investigators look at first. Public reporting suggests the review is centered on actions taken while Powell was serving in his official capacity, not personal conduct outside the role, and not retroactive reinterpretations of policy outcomes. That alone narrows the scope considerably. In practical terms, prosecutors would be asking questions like, were communications handled according to established protocols? Were disclosures consistent with ethics requirements? Did any internal decisions intersect with legal obligations in an unusual way? These are technical questions. Uncomfortable, yes, but not dramatic. And that's precisely why this story is easy to misunderstand. There's a tendency to frame any DOJ involvement as inherently adversarial. But in many high-level cases, reviews begin because systems demand verification, not because wrongdoing is assumed. In fact, for institutions like the Federal Reserve, not reviewing potential concerns can be more damaging than conducting a quiet, methodical assessment. From that perspective, scrutiny can actually function as a stabilizing mechanism, reinforcing legitimacy rather than undermining it. That doesn't mean it's harmless, because even when no action follows, the implications linger. One of the most important but least discussed aspects of this situation is precedent sensitivity. Every decision made by prosecutors here sends a signal, not just to the Fed, but to future regulators, lawmakers, and central bankers. If the threshold for review is perceived as too low, future Fed chairs may become overly cautious, delaying decisions during crises. If it's perceived as too high, critics argue accountability weakens. So federal authorities tend to move slowly, deliberately, and quietly, precisely to avoid distorting that balance. And that explains the near-total absence of public detail. There's also an international dimension. The U.S. Federal Reserve is not just a domestic institution. It anchors global financial expectations. Other central banks model their independence, transparency standards, and crisis responses around it. Any suggestion, even implied, that a Fed chair's decisions could be criminally reinterpreted later sends ripples far beyond U.S. borders. Not panic, but recalibration. That's why analysts and legal experts are watching language more than actions. What's said, and what's not said, matters. Another overlooked factor is timing relative to political cycles. Regardless of intent, investigations involving high-ranking officials inevitably get filtered through political interpretation. That's unavoidable, which is why DOJ protocol emphasizes insulation from political influence and why public confirmation is rare. Even acknowledging a review too early can create narratives that take on lives of their own. And once that happens, institutions lose control of the story. So silence isn't evasion, it's containment. Meanwhile, Jerome Powell continues to perform his role as Fed chair. That in itself is a signal. If there were immediate legal concerns affecting his ability to serve, procedures exist to address that. None have been invoked. Markets notably have reacted with restraint, suggesting investors understand the difference between review and resolution. That calm response may be the clearest indication of how this situation is being interpreted by those closest to the system. Concerned, but not alarmed. Still, the broader question remains unresolved. In an era where transparency is demanded at every level, how much opacity is acceptable for institutions designed to operate above politics? The Fed's independence depends on trust. Trust depends on accountability. Accountability depends on clarity, and clarity is exactly what's missing right now, by necessity, which brings us to the next logical layer of this story. If this review proceeds quietly and ends quietly, it reinforces existing norms. But if it evolves, even slightly, it could redefine the relationship between law enforcement and monetary authority in ways that outlast any single individual. And that's why this isn't just about Jerome Powell. It's about whether modern financial governance can adapt to rising demands for oversight without losing the independence that makes it effective in the first place. In the final part, we'll look at what outcomes are realistically possible, what would not happen, despite speculation, and how this moment fits into a longer pattern of institutional stress. Not crisis, but transition. At this stage, it's important to separate what could happen from what people often assume will happen. Because in cases like this, the gap between perception and reality is usually wide. The most likely outcome of a DOJ review involving a sitting Fed chair is simple. No public action at all. That's not unusual. That's not evasive. That's how institutional reviews are designed to work. If investigators determine that rules were followed, the process ends quietly. No announcement, no vindication tour, just closure. And historically, that's how most high-level reviews conclude. What is far less likely are the scenarios that dominate speculation. There is no indication of imminent charges, no sign of forced resignation, no mechanism for sudden policy reversal tied to a legal review. Those outcomes would require a level of evidence that, so far, has not been suggested by any credible reporting. Which is why language matters. Criminal probe sounds definitive. In practice, it often means preliminary verification, not prosecution. Still, even a quiet ending wouldn't make this moment irrelevant. Because the significance isn't found in headlines. It's found in what this moment reveals about pressure points inside modern governance. The Fed sits at the intersection of economics, law, and politics, and those systems are under strain. Inflation shocks, crisis interventions, public skepticism toward institutions. All of that creates friction, and friction is where oversight intensifies. From that perspective, this review fits into a broader pattern, not collapse, not scandal, but transition. Institutions built for a slower, more deferential era are now operating in an environment that demands visibility, justification, and accountability, often in real time. The challenge is maintaining independence without appearing unaccountable, and that's not a problem with a clean solution. For Jerome Powell personally, the situation reinforces something central bankers have always known. The role is powerful, but fragile. Authority exists only as long as trust does. Every action is constrained not just by economics, but by law, optics, and precedent. And that may be the real takeaway here. Not whether a review exists, but what its existence says about how closely power is now examined. Looking ahead, there are two paths this story can take. One is procedural. The review ends, attention shifts, and the Fed continues operating as before. Slightly more cautious, perhaps, but unchanged. The other is structural. This moment becomes part of a longer conversation about redefining oversight, transparency, and legal boundaries for institutions that were once largely shielded from this level of scrutiny. Neither path is dramatic, but both are consequential. So instead of asking, what did Jerome Powell do? The more useful question might be, what does modern accountability look like for institutions that manage global stability? That's not a question with a single answer, and it's not one video long. In the next video, we'll go deeper into how central bank independence was originally designed, why it's being challenged today, and what happens when trust, law, and economic power collide, without anyone necessarily